Hi, this is Chris Singleton with some thoughts about the market and economic backdrop. Stocks hit a bit of a rough patch late summer as investors started to worry about the odds of a recession occurring. The S&P 500 dropped about 10% over that time period, although it's rebounded a little bit since then. This at the same time that the economy has been remarkably steady. Gross domestic product has grown at over a 2% annualized rate for the last 5 quarters, and most recently in the third quarter, expanded by almost 5%, led by the consumer. This despite the fact that the Federal Reserve has raised the policy rate 11 times from 0 to almost 5.5% over about a 12-month period. Meanwhile, inflation's been cooling. In September, the consumer price index rose at about a 3 to 4% rate, depending on which measure you use, still above the Fed's target, but moving in the right direction. Goods prices are largely under control. It's really on the services side where we're still seeing inflationary pressures, particularly shelter, but early signs indicate that that too is starting to dissipate a bit. The real issue for investors and the real question is the spike in long-term interest rates we've seen in recent months. The 10-year Treasury moved up a full percentage point between late July and early October, hitting almost the 5% threshold, the highest yield in 16 years. And obviously, high long-term rates will have an impact on various sectors of the economy, most notably housing. The 30-year fixed mortgage rate is now just under 8%. So when you combine that with the fact that the home prices have soared in recent years, the typical home buyer is really stretched to afford a home. And that's certainly shown up in home sales. Home sales have dropped to a level not seen since the pandemic, and before that, the great financial crisis of 08-09. So mortgage purchase applications are down, housing activity is down, in large part due to the high cost of financing. Builders and developers are also feeling the pinch. In early 2022, the typical financing rate to acquire land, develop land, to construct homes was somewhere in the 4 to 5% annual range. These days, it's more like 8 to 9%. So, needless to say, multifamily construction has dropped significantly. Consumer delinquencies have always also picked up. They're still at relatively low levels, but whether it's auto loans, credit card loans, the number of consumers that are delinquent in their payments has started to turn up. Student loan delinquencies are still relatively low thanks to the moratorium, but those too would expect to begin turning up. The government also is going to feel some pain from higher yields. The Congressional Budget Office estimates that the net interest on our debt is going to be as much as 20% of government revenues 10 years from now. Could be more than a third of government revenues 30 years from now. The public debt stands at $26 trillion. It's doubled over the last 8 years. And so ballooning deficits compounded by higher treasury yields is really going to put pressure on government finances. There are a few sectors that are benefiting from higher rates. Certainly savers, households with cash, savings. The prospect of earning 5% on that savings is pretty attractive. In addition, non-financial corporations have seen their net interest expenses drop. This because the income, from their cash balances has risen faster than the payments on their debt. So, $300 billion of net interest expenses a year ago for non-financial corporations is now about $200 billion. The Fed has probably stopped raising rates for now. There's no sign that they're going to start lowering rates. The median projection of the policymaking committee has the Fed funds rate dropping to only 5.1% by the end of 2024. It's now at 5.5%. So not penciling in much of a reduction in rates, but certainly just the pause with the next step being rate cuts will provide some support for markets. One silver lining these days is the fact that corporate profits are starting to recover. We've been in a bit of an earnings recession with 3 straight quarters of profit drops, beginning with this third quarter that just ended. The constituents of the S&P 500 are expected to start to see earnings growth again. So the soft landing scenario is still plausible. Long-term rates have backed off a bit in recent weeks as inflation has continued to cool. If we continue to see good profit growth, we continue to see rates pause, if not decline from here, there will be support for the stock market.